What's going on, guys? Today we're going to talk about using a market order. I'm going to show you exactly how you can use a market order to buy and sell a stock and also short a stock. Right now, we're using the platform TradeNet, so this is going to be the same exact manner if you're using something like Thinkorswim, if you're using E-Trade, Lightspeed, any type of these stock trading brokers. Most oftentimes, the advanced trading interactive brokers, interactive platforms will have a montage window like this right here on my mouse. This is called a montage window. This is most oftentimes what you're going to be presented with when you're choosing to buy and sell a stock on these trading brokers and their platforms. Okay, so taking a step further, the reason you would really want to use a market order is because it's very simple and easy to use. Okay, it's the easiest order type you can use when buying and selling shares of companies and stock. Okay, the easiest way to do it, especially for beginners. With that being said, why would you actually want to use a market order? Well, market orders are very easy. So that's the first one. Market orders are super, super simple to use, very, very little work to use them or execute the order. Secondly, market orders help you get in and out of positions very, very fast. Third, when you're trying to get in a position very quickly and you're trying to jump in, chances are by doing a market order, you'll have the best opportunity of getting all your shares filled or the quickest fill. So those are kind of the three things: is getting filled, fast execution, and it's very easy to use. Those are really that's really the only benefits to using a market order. All right. Now, a lot of people will tell you to never use a market order. It's very dangerous. It's very bad. You're going to get crushed if you use market orders, et cetera, et cetera. If you use a market order, you're going to get filled way, way, way above the price you want. And yes, it's possible, but most of it's nonsense, and just kind of brush that stuff off because I'm here to tell you exactly how it works. All right. So when you use a market order, you're willing to purchase any given stock at whatever it's being offered at on the market. So a market order is exactly how it sounds. You'll be filled at the market price. Okay. So look at this montage window. Down here, you'll see that it's divided into two. The left side is the bid, the right side is the ask. So this side right here, the bid side, those are buyers, B for buyers, and then ask side, ask here, sellers, right? So this is the right side, sellers, left side is buyers. So very important to know. Don't get those mixed up, that the left side is the buyer and the right side is the seller. A lot of people get that mixed up all the time, and it causes you a big headache because essentially everything's backwards. Continuing, now that you know that the left side is buying and right side is selling, when you were to go, if you were to use a market order, so let's say I want to buy 100 shares. So you can see my mouse, we're playing around. I'm going to add 100 shares and I'm going to use a hotkey. So all I have to do is hit this hotkey, and now there's 100 shares in there, okay? If you didn't have hotkeys, obviously you're going to have to type it in manually, right? So I'd have to literally type it in 100. But if you have a hotkey, you can just hit a button and it'll load. So right there is where you enter your shares. Now you're like, okay, I'm ready to buy. I think I got 100 shares ready to go. We're going to do this. I'm going to buy this, right? Now, if you have a hotkey, you can just use a hotkey to buy. But if you didn't, you'd actually have to click the buy button. For this video, we're just going to use our mouse and click the buy button. Now, when I was talking about what price you're going to get filled at, you're going to get filled at whatever price the market's offering when you do a market order. So how do you know what the market is offering? Well, it's not very hard. All you have to do is look at your montage down here, and whatever the bid is saying, that's what the market is. It's either 1705 or 1706, 1705 on the ask. Okay, so let me state this. If you're going to use a market order and you want to buy any company, so if you're going to use a market order and you're going to buy whatever company it is that you want to buy, and you go and place the buy order, you're going to get filled at whatever price is being offered on the ask. Let me repeat that. When you buy stock, you buy shares, if you're buying them, you're going to be filled at whatever price is being displayed on your level 2 on the ask side, on the selling side. That's the price you will be filled at if you use a market order when you're buying stock. So let's say you buy whatever company with a market order. When you go to sell the shares, and if you sell them with a market order, you are going to be getting filled at whatever price is displayed and or being offered by the market, which is going to be displayed on the bid side. Okay, so when you buy using a market order, you're filled at the ask price, and when you sell using a market order, you will be filled at the bid price. Okay, that is how it works. Before I show you how it works when we actually buy it, I want to talk to you about this. Many will say that market orders are really bad, and the reason they say they're really bad is because you're going to get filled at a price you did not want to get filled at, or when you sell, you're going to sell at a price you didn't want to fill at, which is true. This can happen, okay? And it only happens if the price is moving so fast on the level 2 that you really can't keep track of it, okay? So again, the only time you're really going to get kind of hit with unwanted pricing when you go to sell in a market order. So let's say you buy something and you're going to sell. The only time you're going to get filled at a price you don't want, or you're going to sell at a price you did not want, is when the stock is moving so fast that when you thought you were selling at $1, right, it may have dropped to 90 cents by the time you hit the sell button. So that's the downside to market orders, right? Is you're going to get filled at whatever is being displayed on the level 2. So if by the time you go to put in your sell order or your buy order and the price changes here and you don't notice it, or you still send through your order, you're going to be filled at whatever price is being offered. Okay, so that's where the market order offers zero protection, because you're going to get filled at whatever the market is. So if when you're looking at the montage and you're looking at your charts and you're looking at the price and you're like, oh, it's only $5, I want to buy it right now with the market order. By the time you go to hit buy, it's possible that that stock is going to jump from 5 to maybe $6 and you didn't even notice it. By the time you hit buy and execute it, the price may be $6. You're gonna go, what the heck? That's not fair. This isn't the price I wanted. I didn't execute. No, that is because you're putting in a market order. So if the market jumps by the time your order's executed, you're going to be filled at a different price than you originally wanted. So this is where when you're using a market order, you have to be very cautious and understand how fast or what kind of incremental changes the stock you are is trading on, right? If it's a very volatile stock and is jumping from 40 to 50 cents, $1 a share spreads, yeah, you don't want to put in a market order, okay? But if it's only changing by pennies, a market order is not really bad, okay? So you have to know when and when not to use one, all right? So you don't want to use a market order if the spreads are really big. If there's really big spreads from, like say this was 17 here or 17 here and this was 20, yeah, you don't want to use a market order because you're already going to get filled $3 higher than, what the market is. If this is 17 over here on the buy side and it's 20 on the ask and you put through an order for 100 shares on a market order, you're going to buy those shares at $20 when really, if you went and tried to sell them right away, you'd have to take a $3 a share loss. So it's good to use market orders when there's a tight spread and it makes sense. But if there's not a tight spread and the spread between the bid and the ask are really, really big, and all we're talking about spread, what we're saying with the spread is just the difference between the two, okay? That's what we're talking about, the difference between the bid and the ask. If it's a really big spread and you put in a market order, you'll get crushed. That's when you don't want to do that. So let's say I want to buy 100 shares of UVXY, the stock in the upper right-hand corner. Ready? Whatever price is being displayed here on the right side, that's what I'll get filled at. So let's go ahead and we're actually going to take this down because there's no point in buying that many. So let's just take it down. We're going to take it down to 50 shares. So I want to buy these 50 shares. Ready? I go to buy. As you can see, it goes to 17.21. That was the average cost. That's where I got filled, was at 17.21 because that's what the market was offering when I went to buy it. It's actually up. I got filled at 17.21, so I'm up about 2 cents a share right now. So not a lot of money, hardly nothing, but I am actually green on this trade. So let's say I did want to close out my order. Let's say I wanted to close out my order and sell my 100 shares. I would come over to here to sell, and all I would have to do, since I'm on market, right? Since I'm on a market order, all I have to do is sell. And I didn't touch on that, but when you're using your montage, you have to make sure that you come in here and set your order type to whatever you're trying to do. If you want to do a market order, it has to be on market. If you want to do a limit order, it has to be on limit. So let's talk about the market here. So if I want to sell and lock in this profit of a whopping $4, all I have to do is come down here and click sell. And oh, I only have 50 shares. So I want to sell these 50 shares and I'm going to try and get out here at 17.30. So I click sell. Oh, but you see that? By the time I clicked it, the price changed to 17.29. So by the time I clicked sell, the price had changed to 17.29 and it was not 17.30 or 17.31. So that's where you run the risk of maybe getting filled at a price you don't really want when you're using a market order. Okay? So that covers market orders. When you're buying and selling using a market order, you'll be granted a price at which the market is offering or being displayed down here on your level 2. Very simple to use a market order. I hope that helps you guys. Next videos will be covering limits and stop losses and etc.
What's going on, guys? Kind of back at ya. So, like I stated in the video previously, within this course, you are able to find supports on any time frames, but I did mention strongly that the most reliable is found on a longer time frame. So, support is more reliable when it's found on a longer time frame, but that doesn't mean you can't find it on 1-minute charts or 5-day charts or 10-day charts. So right now we're looking at the stock AMD, and this is a pretty good example of an area in which support held up a few times, right? So if you zoom in within this area, you will see that we had the stock bounce on the area of $13.55 quite a few times, right? So if we draw this line like that, you will see that this area was holding up as a strong support, which is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 20 times or so. All right. And like I said, just because an area is holding up as support does not mean it has to bounce off that area strong or continue up once it's found a support. Okay. So we can treat areas of support as a potential buy and a potential short. Now, we're not going to cover shorting in this lesson. This is just for stock support. But you guys are going to get firsthand look at what it means to short stocks within this course, as well as, buying long. So, just a quick brief rundown that when we find areas of supports, they really do one of two things. Either they hold up and the stock then bounces and then goes back upwards, or you see what happened here where it kind of just hung around this area, and then eventually it broke support. And what happened once it broke the support area? We had a huge drop to the downside. We actually had this is about a 1% move, about a 0.7% move. So almost a 1% move from 1350s down to 1346. So not huge as far as the dollar value, but that's a pretty big drop considering, it was just hanging in this area. So again, when we found areas of support, they can bounce off those areas or they can crack those areas. And then a lot of times short sellers will come in and short it below that crack, or you get panic selling, which is what you see here, panic selling. All right. So just because, supports hold up does not mean, or just because you found support does not mean that it's going to hold up 100%. All right. So, even in this area, you can see that it was starting to hold up a little bit of a support right in the 1345 area. You see we have two bounces off this area, 1 and 2. So there's an area of support. So like I was saying, you can find supports on really any time frame. Even in this area, right? We have support. Tiny, technically it's support, but those aren't strong supports. Just because it bounced there once, twice on a 1-minute candle does not make it a strong support. What's a strong support is when you look back in these 1-year time frames, right? Now that's a strong support, right? We can see that is definitely a strong area of support right in this $12 area. All right, let's go ahead and just pop into a 20-day, 1 hour chart. All right, so on a 20-day, 1 hour chart, where is it do you think we have found some type of support? Well, you're right. It's really right in this $12.50 area, right? So if we kind of draw a line, you can see that the stock tends to bounce, kind of hold right in this area. Sure, it dipped below at one point, but then it came back up and kind of fumbled right in this area. So we have one, kind of two, three, four, and five on a 20-day, 1 hour chart. All right. So that just goes to show that it is very possible to find supports on any time frame. But like I said, the longer time frames tend to be the most reliable. So when you're going based off of supports, really you want to try them on longer time frames when it comes to actually timing a position. Now, you're taking this course for momentum trading. So a lot of times when it comes down to momentum trading, we don't even really necessarily have to focus on areas of support as strongly as some type of swing traders would. Swing traders will really use supports and resistances more than momentum traders. We still use them, but not the same way that swing traders would. Swing traders are the ones that are going to look back in later time frames and try and predict future price movements based on support and resistance levels. Whereas a momentum trader, a lot of times we're looking for the stocks on the way up. So chances are we're focusing more on the resistance areas. So we're going to cover resistance here soon, but support is still a very key concept that as a trader, or especially a new trader, you really have to understand. Okay. So before we get into some technicals as far as um, there's different ways to spot support. Let me put it that way. There are different ways to spot support, but first we're going to have to go into learning resistance before we can actually touch on the kind of more technical side or more sophisticated side of stock support and stock resistance. Okay, so this was just a brief video running you guys down that you can find supports on any time frames, and it doesn't necessarily have to be on a 1 year or a 5 day. It can be on any time frame you choose, but just please remember, use the longer time frames as they are much more reliable. What's going on, everybody? It's Connor coming back at ya. So in today's lesson, we're talking about moving averages. So all these colorful, beautiful little colored lines you see here on my chart, those are called moving averages. These are going to be a very common thing you will see amongst many stock traders' charts. Some may not have as many, some may have more than others. Okay, there's really no limit, or there's no how do I put this, there, stock traders have their own way of doing things. Everybody does their trading a little bit differently. So just because you see these on my chart in these colors doesn't mean that another person doesn't have these exact same ones on their chart, but in different colors. So other people may have them look or have them different color coordinated, and other people may have more, or other people may have less. But whenever you see a colored line that looks like this on somebody's stock chart, it's a moving average. Whether it's a simple moving average or an exponential moving average, it doesn't really matter. Long story short, it's a moving average, okay? There is a difference between a simple moving average and a moving average. I will cover simple moving averages within this course, but right now we're talking about exponential moving averages. And I will go over the difference right now. All right, so the reason I use exponential moving averages is because they are weighted. Let me say that again. They are weighted a little heavier than simple moving averages. So what does weighted mean? It really just means that the price action, or the direction, the movement, the flow, the overall movement of these lines reacts a little faster than a simple moving average would, okay? So all an exponential moving average does, it just moves quicker, reacts faster in correlation to the price chart. As you can see, the 9 moving average here, this blue one, you see how it follows the stock price very closely. Then when the stock drops, it kind of drops. And then when it goes back up, it kind of goes back up. And it follows very closely to the pattern of the stock. That's because the blue line is calculated for a 9-day moving average. So a moving average is a calculation. It basically calculates the average movement of that stock over any given amount of days or time period. If I were to make this blue line and turn this into a 1-day moving average, then it would literally follow the same pattern and same direction, exactly 100% the same direction as the stock, because it's calculated for the average movement of the stock for 1 day. So it's going to do the same exact thing as the stock is doing in that day. But since this blue line is calculated for a 9-day moving average, then it's going to lag or kind of stay behind the actual movement of the price by a little bit, because it's not an exact to what's going on in this day. So then if you move down to this orange line, this is a 20-day moving average. Now you see there's a little bit of a gap from the orange line to the blue line, and that's because this is a 9-day calculation. This is a 20-day calculation. The red is a 50-day calculation, 100-day calculation, and 200-day calculation. So a common question you're probably thinking to yourself is, well, which one is the most reliable, or what do they really do, or what is the purpose of them? So there's a few things to mention here. And the best way to think of it is so we've already gone over, by this time you've gone over support and resistance. Okay? So as we know, support can be, just an area in which the stock has trouble going through, resistance, an area in which the stock has trouble going through, and support would be an area in which the stock has a trouble going below. So then, stock goes up, it touches resistance, may come back down, touch support, go back up, right? So now we have a clear resistance and clear support. Well, what if I told you that when a stock is moving up and it keeps setting new highs, well, you can't really calculate a resistance because, look what happens. This could have been a resistance. Well, it just broke through that. So now there is no, where's the support? Where's the resistance kind of thing? So, long story short, your moving averages on your chart, all these lines, they act as an intraday or long-term support or resistance. Now you're saying to yourself, well, I thought support was a line. Well, yeah, it can be a line, but it can also be these moving averages as well. And what I mean by that is watch how this stock price went up, up, up. It pulled back, and you see how it kind of hung around this blue line for a little bit, then went back up. So there's an area of support on this blue line, but that's not as good as an example as maybe this right here. Boom, where the stock dropped. It just barely tapped below the 100 moving average before moving back up. Come over here and wha-bam, right onto the purple line, right there on that purple 200 moving average. And then it bounced, okay? Now something I do want to mention out before I go further is that this purple line, this 200, the 200 moving average calculation is by far your strongest, most reliable, most respected, most watched moving average amongst any that are on my chart and amongst any that anybody can put on their chart. The 200 is, for whatever reason, in the stock trading world, the most commonly respected and well-known moving average, next to probably the 50, right? The 50 moving average, which is the red one. So really, this is the most respected, followed by the red one, which is this guy right here. So moving averages are support and resistance intraday. So as you can see, the stock price went up and then it dropped and it caught itself, found support on the green one. Then it moved up, caught itself support on the purple one, right? And then it bounced. So you could be asking yourself, well, how do I know which one's going to hold up in the middle of the day? Well, you don't. You don't know exactly which one is going to be treated or, hold up as a support or a resistance, okay? We never know exactly what's going to happen with a stock. But what we do know is we can put these indicators and these tools on our charts to give us a better idea as far as what can potentially happen. Because right now, all you know is that I said each one of these lines can act as a support. So if you look at the chart and we zoom in, you go, well, Connor said they can act as a support. It fell through support right here. What if I wanted to buy in this line? I did, and now I'm in the negative. Well, I didn't say to buy when the stock hits the line. What I said is it's possible it might act up as a support level, right? So if you come up here and we drop down to this green and we actually successfully get a bounce, direction changes, okay? And then once we really break up above these moving averages right in this area, that'd be a smart time to take an entry. And I'll go over moving average crossovers in this next video, okay? We don't want to confuse you too much about what's going on. So the main takeaway from this video is that each moving average you see acts as a support and a resistance on the daily chart, the monthly chart, any chart. Whatever chart you're looking at doesn't matter. Whatever time frame you're looking at doesn't matter. All these lines are supports or resistances. So there are areas in which the stock may find its footing and bounce back up. Or if the stock is below it, it's an area in which the stock may come up, tap it, and then fall back down because it's a resistance. When the stock price is above, they are supports. When the stock price is below, each one of these lines can be a resistance point where it has trouble bypassing. In a later video, I'm actually going to explain the importance of the 9 moving average. I think this is a good area to leave off on this video, describing that they're just moving averages. They're a calculation that projects the overall movement of a stock based on the daily value input you provided. So this is the 9-day moving average. This is the 20-day expected moving average of the stock. This is the 50, this is the 100, this is the 200. These are all an expected moving directional average of the stock over the given period of time in which you apply them to. Okay, so I'm going to leave it off there. Hop on to this next video. The next video, I believe, I will go into explaining the importance of the 9 exponential moving average. What's going on, guys? Back at you. So in the last video pertaining to moving averages, we covered the 9 moving average. And then prior to that video, we talked about, or I touched more on the fact that moving averages are support and resistances intraday, right? So we know that the moving averages act as a support and a resistance. So in the first video, I covered more specifically on examples of the stock price holding support on any given moving average. And like I stated, when the price action is above the moving averages will be treated as a support line. When the price action or the price of the stock is below its moving averages, it will then treat each moving average as a potential or possible resistance area. So I chose to use the stock HMNY to do a video on and give you an example, right? So basically disregard all of this action here and we kind of come down and then we sell off some more, right? Now it becomes quite obvious that as you see the price dips, it comes up and it touches the 200 moving average and then it becomes rejected. Comes up, gets a little bit above the 200 moving average and then it is rejected. And then we drop. And then as you can see, the price continuously rides these moving averages. So it pops down here, all right? So it's the exact same thing, except this is going to the downside. So going to the upside, remember where we talked about the 9 moving average, how the stock tends to pull back to the moving average before continuing in its overall direction. So as you can see here on the downtrend, we come up, we get a little extended here, and then it pulls back to the 9 moving average. We drop again, we get a little extended once again, or a little far from the blue line, and then we pull back, and then we continue in that downward direction. Here is where the direction kind of slightly changed back to the 20-day moving average. And then as you can see, the 20-day moving average held up as a line of resistance, and then it continued on to this downward path. So the main takeaway is that when the price action is below the chart, it will act as a resistance, and when the price action is above the chart, these lines will act as a support. So as you can see here, the price broke the 9, the blue line. It broke the 20, the orange line. It broke through the 50, the red line, and then it finally popped up above the green line, but really found the resistance on this green line before continuing its downward path once again, going into after hours trading. So the main takeaway is just another example of, you know, when the price action is above, it's the moving averages are treated as support. When the price action is below, they're treated as resistance. So as you can see here, right, we went over this side of it, and you see that, it's coming down and then it pops back to the blue line, and then it goes again and it comes back to the blue line, goes again, it comes back to the blue line. And then we look on the inverse and it's the exact same thing, except it's just opposite, right? On the flip side, when it's going up, we go up, we get away from the blue line, it comes back down. We go up, we get away from the blue line, it comes back down to the blue line, then it runs up. We come to the blue line, runs up. We come to the blue line, runs up. And then, as you can see here, we broke through the blue line, had a lot of selling pressure, maybe even some shorts coming in, and then the averages cross over. All right, so there's also some other things to mention here. Not only do moving averages act as support and resistances, they actually tell you a story of the potential change in direction of the price action. So they can kind of give us an idea as far as what direction the price may go. And a good example of it is right here. Okay, as we can see, the moving averages have flip-flopped, right? So we have the purple on top, then we have the green, then we have the red and the orange and blue, right? So this would essentially be, it's a downtrend, right? So it's downtrending, downtrending. Then you notice the price jumps up. So then our moving averages come a little bit closer together, right? They come closer together. They break back below, right? So now we're downtrending again, right? But right here, they flip-flop. They create that weird illusion. It's like a flip-flop where the price was below, but then all of a sudden the price action jumps up and the moving averages actually do this little twisting motion. It's kind of hard to tell here, but they actually twist over. So you have your 9 breaking your purple line, 20 breaking the purple line, and 50 crossing the purple line. When you have moving averages cross over like this, that is a strong indicator of an uptrend, but only and only if they actually successfully cross, okay? Because you can have this blue line cross over the purple, so you can have your 9 EMA cross your 200 EMA quite easily because it follows the price action so closely. Then you come over to the 20, and as you can see, the 20 didn't cross, right? It didn't cross right away as soon as the 9, so it took a little bit less time, or sorry, it took a little longer of a time. So your main takeaway here is that when you're seeing your moving averages all cross over, that's a strong indication that we may be seeing an uptrend. So not only do the moving averages act as support and resistance areas, but they also tell us the story on which direction the chart may tend to go. The wider the moving averages become, the space between them, the greater the actual trend, or the quicker the price jump was. So when they're all close together right here, when all the moving averages are very close together right here, really the stock is consolidating. That's really what we're seeing, is the stock doesn't know which way it wants to go. It's really just a consolidation. But when we get this clean crossover like this, that's an indication that we are in fact going into an uptrend. Now, I will end this here, but I'm going to move into more videos on moving averages so that you can get a better idea of what it means when these moving averages actually cross over. Because just because they actually cross over does not mean that the stock is going to go this high. They could cross over and then it come right back down. So I will go into more about moving average crossovers in this next video.
What's going on, all you beautiful people? So, since we kind of just got done, or you should kind of be done with the whole support and resistance course or lessons, now it's a good time to move into drawing trend lines. because support and resistance are basically trend lines, but they're just flat. So they're really not trend lines, but they're a support and resistance or a flat line you really draw out. So that kind of goes hand in hand with trend lines because trend lines are used to predict future areas where a stock can bounce or will bounce. And they give you an overall trend, so an idea as far as where the stock can go. And they're a way of mapping out support and resistance through a trend, is the best way I can put it. We will use the stock HMNY, but first, I'm going to do a little bit of a drawing here for you. So, starting here, if we have a line that goes up like this, that is not a trend. Okay, so what I mean by that is if a stock is just going straight up, right? That's not a real trend. Okay, there is no trend there. Just because one person still wears the whitewash pants does not mean it's a trend. Okay, you know what I mean? Like just because one person wears it does not mean it's a trend. If a couple people wear it or are wearing whitewash pants, the trend may be starting to pick up. Or like those fidget spinners that just came out recently. Yeah, those fidget spinners. That became a trend, a fad, very quickly. But in order for there to actually be a trend, there has to be like a rejection first, is the best way I can put it. So let's go over this, right? So just because we have a line does not mean there's a trend, right? Just because the price is going up doesn't even mean it's trending. All it means is it's going up, okay? So here's what some people think a trend is, but this is what a trend really is. Let me just draw this out. It may go like that, and then it may pull back a little bit, and then go this way, right? That is a trend, okay? This is an actual trend. I'll draw another one. This is a trend. And of course, they're not always going to be picture perfect, like it may seem I'm making it, but they're not going to be picture perfect. So let's go over these, right? Let me get some text in here. So this will be 1. This will be 2. And this one up here will be 3. Go down here on this one as well. 1 and 2. All right, so let's talk about this. So as you can see, I have on the screen 1, 2, 3 and 1, 2, and this one doesn't have anything. There is no 1, 2, there is no 1, 3, there is just nothing actually there. So first, let me state that in order for there to actually be a trend, the stock has to pull back and set in a low. There at least has to be one low for there to be a trend. If the stock just continues up, there is really no trend to go off. This thing could just fall off a cliff at any time and just come straight down, right? Let me change this over, get back to my drawing tool. So just because the stock is going up does not really mean it's trending. It just means it's going up, and at any point it really could just go boom and just fall straight down. Okay, so with that being said, we need at least one low, right, for there to be a trend, and then the stock has to go higher. Now we know that it went up, it came down, but it bounced, and now it's continuing up. So now we're trending up, all right? And for a trend to stay valid, you want the second low, this low right here, to be higher than this low. If this low, this point where it pulled back, if this were to get extended or fall further than this one, that means the trend is no longer valid, right? So we have our first initial move up, we pull back, we set in our first low of the trend going up. When we continue higher, we set in our second low. This low is higher than this low. We continue up further. We set in a third low. This third low is higher than the second low, and it's higher than the first low. So 1, 2, 3, we have 3 lows, 3 highs, and soon to be a 4th high. That is what a trend looks like. It has to continue up and it has to continue to put in higher lows. Don't let the term higher lows confuse you. All it means is each low point of the trend is higher than the previous low. So this one is low, this one's higher than this low, and third is higher than low 2. So same thing here. We move up, we put in our first low, we move up, we put in our second low, but the second low is higher than the first low. Okay? So for there to actually be a trend, there has to be something to go based off of. There is nothing. That tells us nothing. Just a straight upward movement in a stock doesn't tell us anything. And all we know is that it could fall down at any point or continue to go higher. What this tells us is that we moved up, we pulled back a little bit, but continued higher. So we rejected selling off. We wanted to continue to go up. And by putting in a second high, that just confirms further that the trend is valid. So I'm going to go ahead and delete these off of the chart so we can actually look at a stock chart. And now you can see what I'm talking about. So now that we're looking at something that isn't completely too obvious, right? We're looking at something where it actually has, charts. It's not just picture perfect, right? So you may be asking yourself, how do I spot the trend? Well, let's first start off by doing it. We'll go in this area right here. We'll just use this one, for example, from like here to here. So at the start of this day, we have our first low. But we can't draw a trend line. There is no trend line, right? If I went from here, remember I can't just draw a trend line straight up. There is no, I would be crossing over the stock price to go up, right? And there's really no low here, right? You could say that, I'll draw the trend line and it'll go from the lows of these candles, right? So you could draw a trend line from here and just go straight up. But that really isn't correct because we first need the stock to pull back and create an actual low before we can draw a trend, right? So in reality, the trend would have been like this. From here to here. And the trend line would continue up until either the stock continued to rise or the stock broke through. But since the stock broke through, that trend line would no longer be valid and you would have to delete it and then move your trend line out like this to continue to follow the stock. And every time the stock breaks through your trend line, you would have to move it to the new lows. And for whatever reason, it just keeps deleting my trend line off the chart, which is ironic. So now that we actually have a low right here, and it seems to have held up, right? So we go from low of day to that low, and now it's holding up, and now it looks like we're bouncing, but then it breaks through again. So then we continue to fix our trend line, and now we form another trend line, and then it breaks through there. So now the trend goes like this, and as you can see, it's just a waiting game. You do this all day long, where you fix your trend line, right? You keep going from the lows, and it has to be a clear low, right here. And now you see that there's an actual trend, right? So you found it. You go from this point to that point to that point, and then it holds. It holds the trend line. Then as we progress into the trading day, right, there could be long-term trend lines and short-term trend lines. So this trend line continues, right? This trend line would continue, and it'll look something like this. Something like that, right? But, that's pretty far from the price today. So then what we do is we go, okay, that's an initial trend line, but do we have a new trend? We do. From here, we follow the lows of the stock. So we put in our first low of the day here, our second low, which is higher. So we have our first low, second low. We have a confirmed trend, right? So trading this would be stock pops up, we pull back, set in our first low. Now we have a trend line that has been able to be drawn. We have a trend line that we can now draw because we have our first initial pop, pull back, then we bounce. Now we can draw the trend line. And next thing you know, we pop up, we sell off, the stock price comes back down to the trend line and bounces again. Now we've confirmed this trend is valid and we can justify taking a position here. And the smart entry would be playing the break of the day, the high of day, which is right here. Right? So you pop up in the morning, you set your high of day. We pull back, put in our first low, like I drew before. You remember how I went like, we got initial move up, right? So the initial move up, our first pullback to set in our first low of the day, then the move up, and then ideally we want to pull back again to confirm the trend, right? So that would be our trend initially, then we move up, and then we want to see it pull back, but not quite as low as this guy so that the trend stays confirmed. And now we can justify taking a position in here knowing that it's starting to bounce off the trend line, and chances are we're going to go up and continue higher. So right here we get our initial move up, we pull back, first low of the day, we pop up a little higher, set in our second low of the day, which is higher than the first low, right on the trend line, confirming that this trend is valid and other traders are respecting that trend. Now we can justify taking a position, and better yet, when we take that position, we can play the breakout of the high of day here, right? Because it is possible that although the trend is confirmed, the high of day could act as a resistance point in which if we were to get in right here, there's a good chance, most likely it would break out. But, every once in a while you'll run into where you get in a little early and then it pops up to the high of day, hits resistance and actually breaks the trend line, and then you lose. So if you play the breakout here, you're confirming that you've broken through resistance, trend is valid, break through resistance, take in a position, and then you ride the wave up. All right, so let's continue this. And then as you can see, as the day progresses, stock moves up, pulls back a little bit, doesn't quite reach the trend line, does here, holds up on the trend line. We move higher, we pull back, we bounce off that trend line. But then as the day progresses and the closing bell comes, the trend is then broken, and as you can see, it now is no longer valid. This trend line here is no longer valid. So that trend line would be of no real use to you. Well, actually, it is, but not for your support. All right, so then you can see that that trend line was a support, and as it goes up, right, so we had our support trend line, then as soon as it breaks and it continues, the stock then treats that area as a resistance point. So let me delete some of these drawings and then we'll go back over this. And this video may get a little long, but there's going to be a ton of jam-packed information that you really just got to bear with me and stick with it, right? So let's draw this trend line, right? We'll redraw this one where the stock is following this trend line very strongly. Why is it doing that? It just like keeps deleting the trend line. So we're drawing our trend line, right? And you can see that's kind of how that trend line went. All right, but once we break through here, this trend line is no longer valid as a support, right? So now we have a new trend, which was set when we have a new low. Once we broke through this trend line that I'm sitting over top of, once we broke through the trend right here, that trend line, we then put in a new low right here. So now your trend would go from here to there. And now this becomes the new overall trend. Then look what happens as we progress. So if I were to, I have to actually zoom out a little bit. So if I take my trend line, draw it from that little low point across that new low, once the first trend line was broken, we put in this new low. So that's the way our trend line goes, right? So disregard all of this price action. Only think about right here. None of this price action has happened yet. None of this and none of this. So we draw our trend line from this point to this low, and we extend this line as far as the chart really can go because that's the overall trend now. Okay? And look what happens. The stock ends up popping up and bouncing right next to that trend line. And then in today's trading, HMNY popped up, came right back down, and bounced right off that trend line. And then almost did it again here. So that's your importance of trend lines. Now, there's another thing we can look at. Just because we're drawing trend lines for support doesn't mean we can't draw them for resistance as well. So let me delete this. And we're going to cover this portion of it, which is trend lines can go up for support and they can go up for resistance. So since we just covered the whole course on support and resistance, this is a perfect time to tell you and then go over, as we've been doing, that supports can be drawn going up and they can be drawn going down, and and resistance levels can be drawn going up and they can be drawn going down. Now, there's some patterns like wedges and ascending triangles and a lot of other wedges. There's upward wedges, upward channels, downward channels, and we're going to go into all of that throughout this course. But, we just got to take it baby step by baby step at a time. So let's do this, right? So look from here. So once we have put in our first, we have our trend, right? This is our upward trend support. We also have an upward trend resistance, right? Just like that. Once we broke through, and the way that works is the same concept, but just a little bit different. All right, so once we have a trend, right, and we pop up, so once the stock goes up, and then it sets in a new low, and then it pops up and sets in a new high, and then it pulls back and puts a new low, and then it pulls up and makes a new high, and it pulls back again. So not only do we have the support going upward on the trend, but we also have the resistance going upward on the trend. So it's trading in this, what we kind of call an upward channel, right? We have go up and go down and go up and go down and go up and go down. So the concept here is that, delete this, we go from the high points, right? So this was our first high. I'll zoom in here. This is our first high of day. And then we go low, right? But we have to set in a new high of day for there to be a trend. And now there's a new high of day right here where we pull back. So now this is our stopping point for the next high of day. So this is the way our trend would go from here to there. Look where a bunch of massive volume comes in. And they follow the chart up, and that's the breakout of the upward trend resistance. Clear upward trend resistance breakout right there, and all the volume takes place right at that breakout level of 21. Pops up to a high of 23. That's a $3 gain, or what did I say, 21? That was like a $2 gain almost instantly within, well, it was 5 minutes, but the breakout was right there, and a lot of volume comes in and people buy it. But here's the thing. Once this broke through, this trend line is no longer valid because this high is now higher than this high. So we would essentially have to delete that trend line. And now we have to start all over again, where the trend would technically go like this. This would be our long-term trend, which chances are the stock isn't going to reach that high, right? So once we put in this new high, if the stock doesn't come back and even get close to that trend line, that means the stock isn't following that trend line at all. As you can see, it just went sideways and it's nowhere near close. So that trend line isn't really valid because we put in such a high that really the trend line becomes like this. Now you start over, right? Now you have this trend line, and now once we put in a new high, right, we have our high. We put in a new high, trend line goes like this to that high, and now we draw it all the way across, right? And look what happens. That was our upward trend resistance, where this high higher than this one, so now we put in our new high. We sell down, we come back up, and as you can see, the stock is treating that line as a little bit of a resistance point now, until today's trading, where it broke right above that trend line and just squeezed right up. And that was also, and there's two things to look at here. You have your pre-market high. So this is your pre-market high. There's something called a pre-market high breakout, which we will cover. All right, so you have your pre-market high breakout strategy, on top of the fact that for those that drew the trend line properly, they would have seen that the upward trend resistance is about to break out, and they purchase. Not only do you have the pre-market high breakout players, but you have that upward trend line resistance breakout players. So there's like a double signal right here. There's literally like a double signal to buy long, all right? So recapping some of that, let's actually just go over to AMD. I've used this one as an example before, but you really just have to because it's so picture perfect, right? Look at this trend. I mean, this trend is, I mean, anybody can spot this trend, right? You have your low here. We pop up. We set in our second low, higher than the first low. So now we have a trend, right? And the trend goes like that. And as you can see, the stocks, and let me repeat that. If we were to go off the very, very tippy bottom, you'll see that, it never actually quite came down to that trend. So again, it's kind of the same concept as support and resistance areas, okay? Because you can't treat them exact price points. What if I draw my trend on the very bottom of this line, right? So think about it. Think about the 100 million traders that are out there in the world, right? Do you think everybody, think about the amount of pixels that are on someone's computer. What if someone looks at something that's 720p versus I'm looking at 4K versus someone who's looking at 1080p, someone who's looking at 420p or whatever? People have different charts. They have different screens. They run different colors. Okay, there could be a numerous amount of things or different things that kind of, shift or change the way someone's chart screen looks. So, what if I'm, and look at it this way. Think about this. What if I'm drawing my trend line for the stock when I'm looking at it I'm looking at the stock and it's this zoomed out when I draw my trend line, right? So chances are I'm not even going to draw exactly perfect on the tippy bottoms, right? And then you have some guy that's drawing the trend line. Oh, that's way too zoomed in. Then you got some guy that's drawing the trend line when he's this zoomed in. So he's going to have a more clear picture and he'll be able to draw it a little bit tighter than I can, right? Or think about someone who's running it on 720p when, other people are running it on 4K now, right? Things are more clear on their charts. So just because of reasons like that, you cannot treat supports, resistances, or trend lines as 100% exact price points. Just because the price dips below it by a little bit does not mean that the overall trend isn't valid anymore. Give it a little bit of time to breathe and react, and maybe, just maybe, it'll bounce back and continue that trend. And it's for reasons like those. Other people have thinner trend lines. Like, look at my trend line, right? This trend line's pretty thick, but I like a thick trend line, right? If I were to make my trend line smaller, I could get it very close to, picture perfect, but I like a bigger trend line to look at. So just because trends don't hold up 100% perfect, doesn't mean they're not valid. And part of the reason could be people are looking, like I said, at, 4K where their computer is way more clear than yours. And you have some other guy that's only looking at 720p where his chart isn't as clear, but he's still drawing his trend lines. And the trend he's still drawing a valid trend. It just may not be as close as yours. So that right there, those 100 millions of traders could be drawing their trend lines just slightly different or slightly off from where you're drawing yours. So the chances of each and every single one of those 100 million traders to have their trend lines be exactly the same is very unlikely. So for the price to bounce exactly on your trend line every time you draw it is very unlikely. The chances of it bouncing on your trend line, if drawn correctly, the chances of it bouncing close to, around it, or maybe a little bit after it, more likely. So just because you draw a trend line and it doesn't bounce right where your trend line was drawn, don't beat yourself up and think that you're doing it wrong, because in fact, you might be doing it exactly right, but other people are drawing them too, and you can't expect everybody to draw their trend lines exactly the same. Okay, so that just means that the price action does not have to bounce off your support levels or off your resistance levels or off your upward trend lines or downward trend lines exactly as you've it drawn. Okay, so just think about that when you're drawing your trend lines, that, everybody does it a little bit differently, okay? And they see things a little bit differently. What if you're trading against an old guy that, sorry to put it that way, but what if you're trading against an old woman or an old man who, whose vision's kind of off and they have to wear glasses. They have prescription glasses and they're wearing glasses and they can't see the charts as well of you, Just think about it in that retrospect. But enough of that spiel there, but I think that's going to help a lot of you guys right there. What I said, understanding that everybody does it a little bit different, sees a little bit different. I'll help you understand that, nobody does this perfect, okay? Just because it doesn't bounce perfect on your trend line does not mean you're wrong. So looking at this chart here, right? This is AMD again. Perfect trend line. You can see that it's basically bouncing off that upward trend line. Yeah, it dips below here a little bit, but that trend is just clear as day. And so you have your first low, or sorry, you're basically your starting point. We pop up, we put in our first high, then we put in our first low, right? Then we pop up, we put in our second high, second low, but technically, this is the first low you pop up. That's second low, pop up. That's third low, pop up. That's fourth low. Then we broke through the trend here, and what happens? The stock drops, right? Find some support in this area. You have a resistance level here, right? You have an upward resistance level. Now look at, right? So this is the starting point. So we put in the high right here. So if I were to draw picture perfect and follow that, you'll see that the price actually never even comes close to that trend line again, right? So we know, right? We know that that trend's no longer good, right? But here's the thing. We pop up, we go up, we put in our new high. So our trend line would technically start like that. But if this next pop doesn't come close, we now have to change our trend line because the trend line would look like this, right? It would technically look like that. But, like, again, I said, it's not going to be picture perfect, so the better way to map this out would be a trend line like that, right? It doesn't have to be picture perfect, but close as you can get it, all right? So that's really all I have for you on the trend lines and trend line drawing. It's really, I could do this all day. You can really do it all day long. And we'll go back to GE because I think GE might be actually a pretty good example if my stock chart ever loads. All right, so even in this, right? So even on GE, and you can do this on any time frame, right? We were on HMNY and we were on a 5-day chart, and now we're on a 1-year chart. So this goes both ways. So let's look at this chart a little bit more. Okay, so we break through resistance here. We really set in a first low here. Then we hold up a little bit of support. Then we break through support. And now it's going down. So there's our trend line, right? That's the trend going downwards. So we're right at about that trend line again. So there's a possibility that we're going to see a little bit of a bounce here. So what happens every time we get close to this downward trend line is we get close and then we pop. We get close and then we kind of either consolidate or we come back down, we pop, and then we pop, right? So here is our high. We're going down like this. We set in that new high, breaks trend line. So now it's going down like this. And you see where that pop happened? So as this trend line's going down, where's the pop? The pop is right here when the price breaks above that downward wedge resistance. And then pop. And now we have a new high. So this initial trend line no longer valid. Now it's like this. Oh, what do you know? We go in, we pop again. So now that one's no longer valid. So now the trend is like this. That is the overall trend. So now what you can expect is that this stock, GE, is going to trade within a channel like this, going down until it successfully breaks out of this downward resistance, right? So imagine what I'm about to draw as the stock price. Imagine the stock bounces off this line where my cursor's at and it starts going up. And then it may fumble around and we do all this like weird shit. It's just messing around, because the stock chart isn't perfect. So I'm not going to draw you a perfect line. And then we eventually break out, right? We break out that line. Once we break out and pull back, if we set in a new low, this whole trend is no longer valid. And now the stock is going like this, right? Because then we'll bounce again. And then we put in a new low. And the trend is now reversed until the trend breaks this and then goes down that way, which we'll get into a little bit later. But that's really all I got for you on as far as the basics of drawing trend lines. Now, as you can see, we're getting a little bit more complicated, a little bit more sophisticated. So I don't know what accent that was, just disregarded. That was pretty stupid. But we're totally going to get into some cool stuff here pretty soon as far as different breakout patterns, different chart patterns. And that's the thing is you can find, chart patterns that you really like, whether it's a channel or it's a downward wedge, and you can get really good at drawing these trend lines, and you can just trade those trends all day long, right? Well, I don't want to say all day long, but you can just get really good at trading a few specific patterns and really just go from there. So, all right, guys, that's all I got for you today, and this video lesson. So I'll see you on the next one.